This slide here shows you different types of financial institutions. As you can see, I highlighted the first two, which means these two are relatively important. You kind of need to know the difference between them. The others are not that important, but it's good that if you understand the performance that they provide, the services they provide. So the first one is investment banks. Investment banks, we actually have already seen it. If you remember it, if you can remember it, we saw it in the part of the capital allocation process. So you see in this slide, in the middle of the indirect transfer process, you see investment banks here. So investment banks plays a role in helping businesses issue new equities. Oh, sorry, not just equities, issue new securities, yeah, including both bonds, equities, or in other words, stocks, right? So that's what investment banks are doing. The service they provide are what we call underwriting. So they help them issue new shares or new securities in the market. While commercial banks actually plays a role here as financial intermediary. So they do not really provide services of underwriting, but they provide services like liquidity prevention. So what it means is that, for example, depositors like us, when we have extra money, we put it in the bank as a deposit, but whenever we need money, we can go either withdraw our deposit if that's enough. If not, we can also go to the bank to borrow extra amount of money, borrow a loan, right? So that's also liquidity. So banks provide liquidity. Our banks are usually liquidity providers. So that's commercial banks. Commercial banks take deposit and provide loans, issue loans. So that's the main difference here. So, okay, now let's go back. Financial service corporations, these ones just provide like they can also issue loans. They provide financial services, but they don't take deposits. That's the biggest difference between financial service corporations and commercial banks. Only commercial banks are allowed to take deposits. Yeah, no any other financial institutions here are allowed to take deposits. For financial service corporations, they can provide you all sorts of services, including issue you loans, provide you financial advices, or other type of services. Other type of services, they kind of earn a fee for their service they provide, but for loans, you pay them interest, right? And how do they issue you a loan? They either use their own money, which is relatively limited, or in most cases, they raise funding through issuing bond. So those financial service corporations can issue bond in the market. So they borrow money from their investors and lend it to you. And then the fourth one are pension funds. We know what pension funds are, right? They are funds that help you manage your money for retirement. Because it's money for your retirement, therefore, they have to be extra careful when they invest your money, right? So they face much stricter regulations in terms of what securities they can invest. They can't buy high risk securities. That's the difference between pension fund and mutual fund. Mutual fund is like for the public, and it's not particularly for pension. Therefore, they are relatively relaxed in terms of what securities they can buy compared to pension fund. But it's also because they are facing the public, so basically everybody can buy mutual fund. Therefore, they also face relatively stricter regulation compared to hedge fund here. So hedge fund is the most risky fund, while mutual fund is in the middle and pension fund is relatively safer. Hedge fund is kind of, they only face a small group of investors, which are usually those rich people. And it's because they only face a small group of investors, therefore they provide customized services. So whatever you want to buy, they can buy it for you. And because their investors are relatively small in terms of numbers, so even if they make a loss, it's those rich people who suffer the loss, right? it doesn't mean that they're not important, but in terms of like the influence, they are relatively their loss will create much less influence to the society compared to mutual fund, because mutual fund faces the general public. So hedge fund in this case are a bit special because their investors are relatively less. Therefore, they face less regulations in terms of the securities, the risky securities they are allowed to invest in. So these are the funds. The exchange traded funds, this is what we call ETF. ETF is usually based on an exchange index. So they are not actively managed. They are just following an index, right? If the market is rising, they are also making money. If the market falls, they also lose money. So in this case, the fund manager doesn't need to put in too much effort to manage the fund. There are different ETFs are slightly different. So the fund manager still need to put in some work, but not actively managed like mutual fund or hedge fund. And the last one is private equity funds. So this one's mainly focus on private equity. That's what we call PE or VC, venture capital. So these ones mainly focus on the to buy like unlisted securities, those startups. So that's the different types of financial institutions. But the most important ones are the first two, or it's only these first two are going to show up in the quiz. The others, you just need to kind of have a basic understanding of them. Okay, so this part is also important because you see I highlighted the title. So this is the to distinguishing between the physical location stock exchange versus electronic dealer-based markets. Yeah, so these two types of stock market. The first one is physical location, and the second one is electronic dealer-based market. So from the name, you can already tell the first one has a physical location. The second one is kind of based on the internet or electronic based, right? So it doesn't have a physical location. And that's also the difference for these two, the auction market versus dealers market, exchange versus OTC, New York Stock Exchange versus NASDAQ. So they are actually these distinctions, these three are actually like one-to-one. So the physical location stock exchange, and a clear example is New York Stock Exchange. It has a physical location. It's located in Wall Street in New York. In front of the building, there's that famous bull. Yeah. So it has a physical location. It has a building. It has offices. People come to those offices to work every day. And it's an auction market where people who wants to buy put out their offers. People wants to sell also list their price. If the two prices meet, they are the same, then the trade succeeds, right? The transaction can finish. So that's an auction market. That's New York Stock Exchange, and it has a physical location. It's an exchange market. While NASDAQ is different. NASDAQ doesn't have a location. It's not located in New York, neither is it located in California. It has no location. It's online. It's electronic dealer based. And it's a dealer's market, which means that it's usually small firms. NASDAQ are started as like mainly for those tech companies in Silicon Valley, right? So lots of startup companies, they need to raise capital, but they are too small, or they're kind of a bit risky to be listed in New York Stock Exchange. So that's how NASDAQ started, and then it's because these are very small companies. Therefore, they don't really have a very active trading community, or the demand, both the demand and supply side are relatively small. It's not like Apple stock. At every minute of time, you always have somebody who wants to buy and somebody who wants to sell. So it's very easy for you to buy and for you to sell, right? As long as the price is like the market price. But if it's a small company, like a company called EEBuy. Barely anybody had heard of it. Yes, it's also listed in Nasdaq, but no one really knows about it. It's very small, and the company's size is also small. Therefore, it doesn't have many shares. So in this case, it's very hard for such small companies to trade in Nasdaq, because if you want to buy, you wait for a long time for somebody who wants to sell. Yeah, you can put your offers there, but no one's interested in selling because there are only very limited number of shareholders who hold shares for this company. And if you want to sell, it might be even more difficult because there are very few people who are interested in buying. You list your offer there, you put your price there, but you could wait for months for you to sell, and in the end you could kind of have to suffer a loss. So therefore, it's very hard to have an auction on small companies, on small companies that listed in Nasdaq. So how can they solve this problem then? Is that they use dealers market. So in Nasdaq, there are lots of dealers. Usually, it's those security companies. They serve as dealers. They are also called market makers. They are making the market. So, for example, if I am a shareholder of EEBuy, this company called EEBuy, I want to sell my shares of EEBuy, but no one is interested in buying. What can I do? I can sell it to the dealer. Yeah, the dealers are security companies. They are very experienced in trading stocks. So even if it's a small company, they kind of have a method of valuing the company stock, so they know whether your price is good or not. If they feel, okay, this is a good deal, this guy is trying to sell the share of this small company at a relatively low price, so we should buy it. The price is kind of undervalued, right? So it's a good deal, we should buy it. Then in this case, the dealer will buy the shares from you. And next time, if somebody wants to buy the company of EEBuy, buy the shares of EEBuy, the dealer will come out and sell it to the person who is interested in buying, so that you don't have to wait there for months to finish this transaction. That's dealer's market. They are there to make the market, to help the transactions succeed, to help liquidize this, to help with the liquidity of the market. So that's the main difference between Nasdaq and New York Stock Exchange. New York Stock Exchange is physical location, it's auction market, while Nasdaq is electronic dealer-based market, it's dealer market, it's not auction market. But the differences are narrowing because many of the startups, they were small when they become listed in Nasdaq, but as they grow bigger and bigger, they never left the market. For example, I think, if I'm not mistaken, Google started from Nasdaq and they never left. And now it's a big company. So the differences between these two markets are narrowing, but still they are essentially still different. So physical location stock exchanges, they have tangible entities with its own building and governing body. That's board of governors. And members usually had seats in the exchange, which have been replaced with trading licenses costing about $50,000 a year in New York Stock Exchange. So you have to buy the license in order to trade in the exchange. Most of the larger investment banks operate brokerage departments. And the exchanges operate as auction markets. Buy and sell orders come in more or less simultaneously, and exchange members match these orders. Yeah, so that's a physical location stock exchange. And the OTC and the Nasdaq. OTC is the over-the-counter market. Yeah, and the Nasdaq is the dealer's market. The relatively few dealers who hold inventories of the securities and who are said to make the market in the securities. The thousands of brokers who act as agents. And it also has computers and electronic networks that provide communication link between dealers and brokers. The bid-ask spread is the dealer's markup. That's how they make money. So they buy at a lower price and try to sell it at a higher price. And many high-tech companies such as Microsoft, Google, Apple, Amazon, and Intel has remained on Nasdaq even though they meet the listing requirement of the New York Stock Exchange. And that's why you say the difference are narrowing now. Okay, and then the next part is about the stock market transactions. So in the stock market, we have this what we call closely held corporations or stocks. They are usually the privately owned by relatively few people. In this case, we call them closely held corporations or stocks because their shareholders are relatively few. And then the publicly owned corporations or stocks are owned by thousands of investors. Most of them are not active in management. Yeah, that's big companies. But small companies that have relatively few shareholders, we call them closely held. There are three types of stock market transactions. The first one is outstanding shares of established publicly owned companies that are traded in the secondary market. Yeah, so those are the shares that have already issued, the currently existing shares that are traded among investors in the secondary market. This is the majority of the transactions happening in the stock market every day. And then the second type of stock market transactions are the additional shares sold by established publicly owned companies. They're called the primary market, also known as the FPO, the follow-up public offering, or the SEO, the seasoned equity offerings. Yeah, so these are the companies who have already issued shares before, but now they need to raise new capital. Then they try to issue additional shares. So in this case, the new shares are not called IPO. They are called FPO, follow-up public offerings. They are not called the initial public offerings, or SEO, seasoned equity offerings. And then the last part is IPO, the initial public offering. Here's an example or some questions. Apple Computer decides to issue additional stock with the assistance of its investment banker. An investor purchases some of the newly issued shares. Is this a primary market transaction or a second market transaction? Yeah, here it's, as we said before, to know whether it's a primary market or secondary market transaction, we need to know whether the company who wants to raise new capital is involved in the transaction or not. Right? Clearly, in this case, it's newly issued shares, which means Apple Computer is involved because they want to raise capital, right? So they want to get the money, they want to issue new shares, and investors want to buy these new shares. So in this case, Apple Computer is definitely involved. So since new shares of stocks are being issued, this is a primary market transaction. But what if instead an investor buys existing shares of Apple stock in the open market? In this case, there are no new shares being issued, right? It's existing shares. So is this primary or secondary market transaction? Clearly, in this case, it's secondary market transaction because no new shares are created. Yeah. Okay, now let's talk about IPO. IPO is also an important topic in this chapter. The IPO is actually abbreviation of initial public offering. An IPO occurs when the company issues stocks in the public market for the first time. It's called IPO. Going public enables a company's owners to raise capital from a wide variety of outside investors. Once issued, the stock trades in the secondary market. Yeah, so that's what IPO means. Means that the company goes public for the first time, issuing new shares for the first time. Public companies are subject to additional regulations and reporting requirements. Notice that firms can go public without raising any additional capital. Yeah, it's possible that they go public, they do IPO without getting new capital. For example, the Ford Foundation sold shares of the Ford Motor Company to the public as the company went public. Yeah, so in this case, in this case, the company went public, but no new capital is issued. In this case, the money just initially was coming from the Ford Foundation, right? But now it's from the public. So in this case, for Ford Motor Company, it never raised new additional capital. It's just the owner of those capital has changed. Before it was the foundation, now it's the public. But it's possible that the firm can go public without raising any additional capital. For IPOs, if the IPO is very popular, which means investors are very interested in this company, they feel, oh, I've been waiting for all these years, finally this company is going public, I can get this opportunity to become the shareholder of the company. I really want to own a part of the company. So in this case, and the price is relatively reasonable, it's not like highly priced, or it's kind of even underpriced. In this case, it will be a hot, popular IPO, and hot issues are often oversubscribed, meaning that too many people want to buy the new shares of this company, and this company is leaving money on the table because there are more demand than the supply. There are more investors who wants to become the shareholder of the company, wants to invest in this company, but they are not taking all the money, right? Rather than having the offer price set by its investment bankers, Google conducted the Dutch auction, where individual investors place bids for shares directly. So in order to avoid this situation, when Google went public, they don't want to leave the money on the table, so they conducted the Dutch auction, where they let individual investors place the bids of shares directly. So how does the Dutch auction work? In the Dutch auction, the actual transaction price is set at the highest price, or the clearing price that causes all the offered shares to be sold. So investors who set their bid at or above the clearing price received all of the shares they subscribed to at the offer price. Okay, so this is an example of a Dutch auction. And not just Google, the US Treasury also uses Dutch auction to sell its securities. So you see that this is an example. These are the demand for the US Treasury securities. So this A person is willing to buy 1 million Treasury securities at the price of 5.5. And then this B is willing to buy 2.5 million at the price of 5.1. And then you have this A, B, C, D, E, F, G, different representing different people with different demand. So what they do is that depending on the size of the issuance, if the U.S. Treasury this time is wanting to issue, let's say, 5 million US dollar Treasury securities, but they don't know what's the price they should put it at, then what should they do? They first rank all the demand based on the price. The highest price is the ranked the on top, with the lowest price in the bottom. And you see that they prefer to sell the securities at high price as possible, right? So if it's 5 million, then A alone is not enough for sure. A, B together is 3.5 million, still not enough for 5 million, right? With C, it's going to be 5.5 million, so it's going to exceed its predetermined size of the issuing. So in this case, A, B, C together should be enough. So the final price is going to be 5.07. That's the price set by C. And A and B, in this case, will all pay the price of 5.07. So this is the final price. That's Dutch auction. So let the market decide what price it should be. But it's okay that you don't fully understand how this thing works. You just need to know that Dutch auction is a different type of auction. That's all you need to know. You don't really need to understand the whole process. It's not even in the textbook. so that's fine. And then this is the S&P 500 index, the total returns that equals to the dividend yield plus the capital gain or losses each year between 1968 to 2014. So you see, in most years it's positive, but in some years it's quite negative, especially in 2008, the most recent global financial crisis. On that year, the S&P 500 is down like 30%, more than 30%. Yeah. This slide, you see, I've highlighted it. So what I want you to know is that how to calculate this market index. You can either have S&P 500 or Dow Jones, or there are many other type of market index. How to calculate it is that you use each stock's rate of return in a given year consists of a dividend yield, which might be zero if they don't pay out dividend, plus a capital gain yield or loss. Right? If it's negative, then it's loss. If it's positive, then it's capital gain. Or it can be zero too if the stock price doesn't change. If it's the same in the beginning of the year and the end of the year. Yeah, so you calculate each stock's rate of return using these two, the dividend yield plus the capital gain yield. And then such returns are calculated for all the stocks in the S&P 500. So there are roughly around 500 stocks were selected to calculate this index. And then you use a weighted average of these returns. What's the weight? The weight is each stock's total market value. To calculate the weighted average of this return, to calculate the market index. That average is called the return on the S&P index, and it is often used as an indicator of the return on the market. Yeah, so the key thing here I want you to know is S&P or S&P 500 or any other market index is actually a weighted average of the stock's returns, and the weights are the stock's total market value for each stock. Yeah, and this one here shows you the where you can find the stock code, the price, and what it looked like. So stock codes can be found in a variety of print sources, for example, the Wall Street Journal, or the local newspaper, or online sources like Yahoo Finance, Amazon, or Google Finance. So this is an example of the Twitter stock code for Twitter in 2015. And you can see this is the stock price. It increased about 1.87% on that day. Okay, so basically that's all for this chapter. The last part is stock market efficiency, but it won't show up in the quiz, so I will skip this part too. If you're interested, again, feel free to read about it yourself and send me an email if you have any questions about it. Okay, so that's all for chapter 2. Thank you all for attending today's class. I'll end it here.